This is Market Insights from Southwest Investments, where we dig into current events and how they affect the markets, but also how they might impact your financial future. Welcome to Market Insights from Southwest Investments, episode 19, Taking Advantage of the Current Markets. Thanks so much for joining us. Today with me, I have Bart Shanup. Bart, welcome to the show.
Good morning, Rick.
So today we're going to talk about taking advantage of the current market that we're in right now. And just as a brief background, we're talking about the coronavirus situation that we have here in the world. It's not the United States, not anything like that. And we've got two things going for us. Stimulus package that was just recently announced and passed by the House and Senate, $2 trillion, largest ever. Mm-hmm. Then we also have, on top of that, a very accommodating Federal Reserve.
Right.
Where does that put us?
Okay, well these are some big movements.
Yeah.
When you have a $2 trillion stimulus package that actually has a backdoor for expansion that could, if this continues to be a big deal, could end up being double that.
That's right, because that's just the beginning
initial
amounts. Right?
That's correct. But just as big of an impact is the Federal Reserve that says they will do anything to accommodate. Okay, mm-hmm. Anything is huge. So what does that mean? Well, what we're talking about here is enormous liquidity, direct money from the government, the stimulus package, mm-hmm. and unlimited ability, seemingly, that the Federal Reserve is willing to go to make sure that borrowing capacity is untethered. Okay, so how does one take advantage of that? Well, there's a couple of different ideas. In general, now these are historic averages, but in general, there are three areas that investors might want to focus. The first is high yield bonds,
okay,
also known as junk bonds. So we all know that bonds can be investment grade, which would be AAA, single A, or AAA, AA, single A, and triple B rated, all known as bank quality. And then below that, you can get double B, single B, medium grade at best. Then we go down into the C's. So C's means these are generally smaller companies or more stretched companies where they borrowed a lot of money. And a weak economy could sink them. But in an accommodating environment, weaker companies may survive. And if they survive, that means their bonds have been discounted because of the stock market, because of the recession, because of the fear that they may go under. The value of the bonds may have dropped dramatically. So if you can buy high yield bonds of companies that survive, you could end up with stock market returns. Yes, historically.
Because, again, just to kind of reiterate what you said, those bonds drop in value, but they're still providing the yield, right? The
Correct.
Yield, or maybe some people might recognize that as interest.
Right.
Is what that is.
Sure.
For that. But in our terminology,
total return should be pretty close or better than the general stock market return. Now, of the equities, the next area to focus on, small cap growth. So think in terms of companies that have a promising product. Mm-hmm. It's easier for them to borrow money.
And I think that's important to just point that out. You just said a promising product for up-and-coming companies. We have to remember, just because we are in a recession or approaching a recession, the stock market where it's at, doesn't mean that companies have stopped working.
Correct.
New companies are being started all the time. And so that's why we want to kind of keep those things in mind.
And we are in a wonderful economic environment when you have high liquidity, low interest rates, mm-hmm. slow growth, and little to no inflation.
All of those are great things for a small company who needs money, typically, yep. And they need it over a long period of time to get their product going in the marketplace.
So traditionally, this is the best time to be a small cap growth company. Mm-hmm. And the third is emerging markets. So emerging markets are heavily affected by energy costs. Well, we've seen what oil is doing.
That's right.
I am not an expert on natural gas. I have to think natural gas isn't all that far apart, but certainly oil is down dramatically. And when you have the oil, the price of oil down and high liquidity, emerging market stocks tend to do very well.
Excellent.
So those are three areas that investors might want to focus on.
Thank you so much, Bart, for that insight. I think that was extremely informational for you to understand how you can take advantage of the current market. So if you're talking with us and we talk about high yield, now you're going to understand. Thanks so much for joining us. We'll see you next time.